Vijayalakshmi Iyer, Chairman and Managing Director of Bank of India, joins us now. Ms. Iyer, good morning and thank you for joining us. In your view, what is the biggest concern facing the industry at this point in time? Is it asset quality or capital concerns or general lack of quality projects to lend to?
See, the concerns facing the bankers are on 2 or 3 fronts, I should say. The first concern is the growth itself per se, weakening growth. Not many projects are really coming into the fray, and what we are witnessing is only the normal growth in the retail side and the consumer segment side, and much better growth, of course, on the agriculture side because of the good monsoon which has come across the country. So apart from that, we are not really seeing very many projects on the manufacturing side. The recent IIP numbers also indicate the same, and the RBI data as well as the financial stability report does indicate that the corporate profitability has really got affected, and they are also struggling to maintain the margin. So on the infrastructure side, of course, not really many new projects we are seeing. Quite a few projects under the stalled projects have, of course, got the green signal and issues are getting solved, but these are really need to get executed on the ground soon with the different departments in the ministry. And of course, this is a positive sign. And once these projects come into stream, maybe over a period of next 10 to 12 months, definitely the revenue stream will start flowing into the economy, and one would see some uptick in the revenue part of it, as well as the credit pickup also.
Right. A few analysts have been critical on PSU banks, citing that they depend too heavily on the government for capital. How do you react to this statement?
Let me totally remove the fallacy which all of you have, that all the nationalist banks are starving for the capital. Absolutely no. All of us are very well capitalized. And take, for instance, our own bank. There is no need to go for the public issue or anything, or dilution of the equity stakes as of now. And augmenting capital is an ongoing thing for the financial services industry. As we grow, we ought to grow the capital also. And large part of it comes from our own capital plowback. So being the owner of the public sector banks, the amount is also taken by the government. So it is not that we are dependent on the government. I think it is, as a shareholder, as a promoter of the bank, they are contributing. So it should be taken in that sense.
So do you have any plans of approaching the market for capital, whether domestic or overseas?
Absolutely. As of now, we have no plans to approach the market for the equity part of it. We did raise Tier 2 bonds in September, 1,500 crores, and we are examining whether we need to go for Tier 1 Basel III compliant bonds. We are just examining it because I don't have the need for it to go right away. So as of now, there is no any need for me to go ahead with the capital infusion.
Your bank has taken advantage of the concessionary window for FCNRB deposits as well. Now that it is about to be shut, will it impact your funding costs?
See, this window of RBI has certainly helped banks like us. We have got much foreign presence. You're aware that we are present in 23 countries and we have about 54 branches. And we have made extensive use of this window, and almost about 1.26 billion we raised through this route. And all in all cost has come to around 8.20 to 8.25 for a deposit of almost 3 years. So hitherto it was cheaper and we have taken the benefit of it. But now with the reduction in the MSF rate in the last monetary policy, this is not a very attractive instrument, but nonetheless we are garnering the deposits and we are not losing sight of it. But going forward, let us see. Of course, the window is likely to close by end of November 30th. So I think we are one of the major contributors for this deposit under this window.
So Ms. Iyer, do you expect asset quality for both the system as well as your bank to improve and what do you expect in the second half of this year when it comes to your book quality?
Asset quality has been an issue. In fact, the entire banking fraternity is actually facing the dual challenge of both the credit growth as well as the asset quality. It is not an either or question. We are battling on both these fronts, in fact. And this is likely to go on for another couple of quarters unless, the investment cycle definitely turns and then turns back and there is going to be a credit uptick. So for the next 2 quarters, there is going to be pressure on the asset quality and consequently on the margin also. Coming to Bank of India specifically, we have been internally working very hard and we have been able to reduce our gross NPA from 3.04 to 2.93 as of September, and also the net NPA from 2.10 to 1.85. I'm confident, and from the estimates which are provided by the department, I feel we should be able to maintain this level going forward in the next 2 quarters also.
So we've seen a number of banks turn to retail lending as the way forward in these tough times. Is that a strategy you would advocate?
See, demand for retail lending is on the increase as of now. Although we are facing downturn on the economy, there has been no pay cuts for any one of us. And you are also aware that the demographics of India, urbanization, and more than 45% of the population is in the employable age with average age of just 29 years. So their aspirations are different, their demands are different. So accordingly, we do see change in the pattern in the consumer loan segment and also in the personal loan segment. So we are trying to take advantage of this, and we are positioning ourselves through all our retail outlets as also the other branches, and we are witnessing a growth of around 30% in each of the schematic lending. And we will continue this because this is one area where there is a growth happening, and we will not leave it, and we will try to increase our market share here.
Ms. Iyer, really appreciate your time and thank you for joining us.